The irony of all these people calling for a credit crisis, and it's maybe I'm crazy, but I see problems. There's problems in commercial real estate. Yes, there's problems in VC and all this stuff. Until you see spreads widen and a real problem, I think you have to play. Like now the Fed's easing and you're going to get inflows into bonds. You're going to get inflows probably in equities. All global banks are now easing. I just don't understand, unless there are credit problems in the system. This is a global liquidity cycle that is going up, and it's not going down.
To me, the big thing on my mind right now is don't fight the Fed. Like Powell was as clear as he could be. Up until now, it was a lot of inference and assumptions, but he made it as clear as can be. Hey everyone, this episode is sponsored by Polkadot. Polkadot is the largest community DAO, empowering 1.3 million DOT holders to shape the future of the network through active participation. With over 500 applications backed by over $6 billion in shared security, Polkadot's adaptable technology powers a diverse ecosystem from DeFi to AI. Join the Polkadot DAO and be part of that transformation. What's going on, everybody? Another weekly roundup of the On the Margin lads. This week, Quinn is away traveling for work, so we have an extra guest coming in today. We got Zaheer of Split Capital. What's going on, Zaheer? How you doing?
Doing well, guys. Thanks for having me.
Stoked to have you on. And what's going on, Tyler? So you got your Freedom shirt on.
Oh, yeah. Hopefully we'll get some interesting news today politically, but we'll see. A couple hours. There's supposed to be an announcement.
There you go. I got my Freedom background on. Powell has declared victory and he's riding the waves of the dove. We made it.
So good.
You know what is incredible? I think you had a great tweet yesterday where you were like, this is the most non-consensus thing ever. But everyone was expecting markets to just absolutely crumble on the press release. Because previous years, if you saw the Fed ease, there was, problems in the system. This time, there's not really many problems in the system we could talk about later. But I think you kind of nailed that one.
Yeah, I mean, I don't know. Like just to paint a little bit of context here, we're recording this right after Powell had his Jackson Hole speech about an hour ago. And I think it was at least as dovish as the most dovish people expected it to be. He basically lined up that, we're cutting. There was no sort of indication of maybe just like a one and done cut. It sounded like a pivot to a substantial cutting cycle. And driven by that is this idea that he and the Fed does not want to see any further labor market weakness. To me, that sets a pretty hard line Fed put where it's just like, we don't want to see the unemployment rate go up any further. So that was super dovish, and markets are reacting positively to that. And just looking at some of the analysis that people have done on this, I don't know, I've seen where people pull up charts of, the last time Powell talked at Jackson Hole, he dumped, and they're just completely missing the context of the situation at hand. 2022 was a completely different world. Yeah, what did you think, Zaheer?
Yeah, I couldn't have said it better. I think whenever we look at these past cycles of monetary policy, or this is also why, this is a controversial take, but when we line up historical kind of price points for any asset, we look at it without any context, without any kind of understanding of how things are supposed to kind of move forward. But really, I think the lack of context with past cutting cycles is a massive detriment. You consider the 1970s and 80s, right? For that kind of cutting cycle post Volcker, right? There's a reason why the market was kind of tumbling and why they were afraid, right? Whereas now, you have kind of a Goldilocks scenario, right? Where it doesn't seem you're getting there's also another consideration that we'll probably talk about at some point, but even this dynamic between 25 and 50 basis points, right? For the first cut, right? Powell also can't say, we're really afraid of the employment market kind of tanking, because then what? Then that scares the crap out of everyone who's kind of watching out. What does he know that we don't know, kind of thing, right? So he obviously has a very delicate job, but I think within reason, there's no real sense of panic consistently for the next couple of months, I think.
Yeah, I agree with that. What'd you get from it, Tyler?
So right now I'm watching, this is just a little bit after it, but the dollar is caving, obviously, because he was very dovish. The thing where I think the biggest divergence between all the bears and the bulls is they are not looking at the fixed income market. And what I'm seeing in the fixed income market is there's inflows. Inflation is kind of at bay, and look at HYG, LQD, TLT, like these are high yield corporate bonds and treasury bonds all rallying today while the VIX is down 7%. And, I put out a tweet yesterday saying there was a massive buyer of volatility in the market. Basically, someone bought some downside S&P puts, almost 150 million in notional exposure. And that's what, the big spike in volatility and deleverage was from the equity market. Well, the fixed income market's just been fine. Like it is just putzed along here, slowly and steadily. And I think what Powell really did was put the put in the fixed income market, which is, inflation's at bay, and we're gonna ease so that the labor market doesn't unravel here. But I have some charts later that we can go into that really show this phenomenon.
Yeah, I agree. Like it was very clear the Fed put is live. I mean, this was a tweet from Nick Tamaros from Wall Street Journal that he put out, and it really just said everything we needed to know. The Powell pivot is complete. Super dovish across the board. A few things that he mentioned. The cooling in labor market conditions is unmistakable. This is really key. We'll get into this a little bit later, but there's been a lot of noise around labor supply dynamics and downside revisions to the BLS report and that sort of thing. But what he's saying is that regardless of all of that, it's still cooling and it's unmistakable. Discusses how, it's unlikely the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. This was a really big one for me because how that gets reflected in the Fed reaction function is that any marginal uptick in unemployment rate that is unexpected will be matched with the same amount of easing as well. So markets are trying to figure out how to price that, but the fact is they're just this matched put that as the labor market weakens, easing will come in to match that. That's the big one for me. I don't know how many people were expecting him to be that dovish. I think a lot of people were just thinking that he would hint towards that first cut and that's about it and just sort of be data dependent and wait things out. But, like you said, we will do everything we can to support a strong labor market as we make further progress towards price stability. They're not worried about inflation nearly as much now.
What we learned about this is, number one, you've been talking about the SOM rule. It's clear that they're watching that. They're watching unemployment rising at an increasing rate, and they want to basically front run that for a soft landing. The other thing that we learned is something that we watch pretty consistently is the forward break-even rates. They're watching that too. They're considering, if you look at forward break-evens, which are 1 year forward break-evens are at 70 basis points versus 1 year nominals. I don't have those up, but that real yield is constrictive to financial conditions. So you basically had these two things, these two indicators the Fed is telling you right now that they're looking at, and most people aren't looking at those. And I think that's, something we've done okay here. There's lots of things we've dropped the ball on, but I think those two things are important for Fed policy that everyone kind of overlooks.
And Felix, to your point, in the last kind of press conference that Powell gave in July, he said he kept reiterating that they went from core focus inflation to now we're getting back to baseline between inflation and employment. I think the biggest difference that I see is that there was no real center period, right? It was only maybe a few weeks of, hey, we can worry about a dual mandate instead of a singular mandate. Now it seems like they're kind of moving towards the camp pretty aggressively on the employment side, right? Now inflation is no longer a material concern, and now you're getting a 60, 40, maybe even 70-30 split between employment and inflation going forward. And I think that's going to be the big trigger that people should start paying attention to more, is the employment figures. And I also want to just impress on everyone who's watching, right? This is the first time in almost 3 years that we've considered employment data material enough to outweigh inflation. So this is a pretty pivotal moment, right? This is not your classic press conference that we've had in the last couple of months, right? This is a very, very large kind of dynamic change in the monetary policy outlook going forward.
That's such a good point. We jumped into the show pretty quick here, but Zaheer, just to paint a little context on what you do in your background, Split Capital is I believe mostly a crypto liquid fund, but I know you follow the macro pretty closely and how that drives your decision making in the crypto space. So, what's your broad macro view? A lot of the listeners know, Tyler and I are on the camp of seen this more of like a growth scare. But when you look at, the credit market, there's no real recessionary issues on the short-term horizon. It feels like sort of like this mid-cycle dynamic. But like, what's your high-level macro view these days, and how does that, trickle into crypto?
So we're pretty data dependent too. I wouldn't say in the same way that obviously Jerome Powell is, but more so in the sense that I don't try to give like a 3-year time horizon on macro conditions. It's more like we have like a shorter dated kind of macro view, and then we have like a very long term macro view. Right, the long term lines up with crypto that like yes, inflation will probably persist over a long enough period of time. People need to buy our treasuries. It's kind of a big problem, right? So that's like the both the fiscal and the monetary policy. And then short term, we're kind of taking it, month by month, quarter by quarter, more than we are taking it like a 1-year plus view, because realistically, like number one, it doesn't really matter for our markets all that much to have a 1-year view. And number two, I think it's a little bit of a fool's errand, because there's so much, data dependency that the Fed kind of operates with now, that they haven't in the past. So, you can't really make like a direct construct of, how bad inflation gets or how bad employment rates get, so that's why we try to, kind of focus on the shorter, kind of horizon.
There's an interesting couple things that happened for me this morning. Is what we are seeing is, super dovish Fed, markets are rallying. And then at the same time as all this was happening with Jackson Hole this morning, we got this new home sales print month over month that just like, check this out. So the forecast was for a 1% increase month over month. Last month, we had a negative 0.6% reading on new home sales. Today, we just printed 10.6% new home sales month over month. Like,
Yeah.
I've been talking a lot about the housing market over the last few months and the decrease into it. But, there's this thing where there's the actual Fed funds rate coming lower, and then there's the guidance of it and how that gets reflected in, the longer end bond market, and that gets directly implicated into mortgage rates. So what are we seeing now? We're seeing people that are, house buyers are saying, okay, we're going into an easing cycle. That's already being reflected in the long bond market. That gets reflected in the mortgage rates. All right, game on. Let's go buy that new house. So it's starting to happen now. And this is why it's, we talked about last week about like Schrodinger's recession versus, reacceleration. And this is why, is because the bond market gets it gets increasingly reflexive due to these market dynamics, and then that gets reflected in the economy. So as soon as you think mortgage rates are coming lower, people start jumping in really quickly, and then now we get this huge upside surprise in new home sales. So this is, to me, showing that I see no recession on the horizon. Like, people are looking at the easing cycle and they're like, game on. Go ahead, Tyler.
Well, you see the home builder ETF's up 4% today and almost making, close to an all-time high, which is fascinating, because 2 weeks ago everyone was calling recession, and so it was. In hindsight, we know that the equity market structure is completely fucked. Excuse my French. And the volatility and leverage that has to be delevered when the VIX pops is insane, especially in an August tape. We got to remember that next summer the market structure's changed. But like, fast forward 2 weeks, now the housing market's all fine. Credit spreads are
rosy.
The liquidity cycle is still going. There's some risks, like geopolitically, that could derail things temporarily. But for now, this is like, I don't know, pretty Goldilocks. And everyone's position wrong. I think everyone's bearish.
Hey everyone, this episode is sponsored by Polkadot. Out of the 500 protocols, one of them is called Origin Trail, and they're building a verifiable internet for AI, ensuring the provenance and verifiability of data to tackle challenges like bias and misinformation in AI systems. Used by global leaders like the British Standards Institution and the Swiss Federal Railways, Origin Trail is vital in sectors like asset tokenization, healthcare, and the metaverse. Powered by Polkadot, Origin Trail enhances the discoverability of crucial knowledge and secures information in the AI era. Power the verifiable internet with Origin Trail at origintrail.io. All right, back to the show. I agree. Tyler, do you want to run through your charts and talk about this credit market that you see going on?
Yeah, let me first talk about, if you go to slide 33, this is kind of out there. But what I think we're watching is, during the Fed tightening cycle, we constricted the US dollar supply globally, and that really put the screws to China. Now, China needs dollars for their whole system to work, and when we constricted that supply of dollars, China, to make up for it, had to like have cheaper goods. So there's this disinflationary pressure is coming from, generally the goods sector. And that's allowing us now to lower rates here. So our forward inflation numbers are coming down because China's been slowing. And this is something that we brought up, over the past couple months, but the Asia dollar index. So when that was at 90, I was really concerned. Like that could be a global margin call on US dollar debt. If that Asia dollar broke lower. And something that happened basically in the last week was, I think there was a giant Shanghai Accord or Bretton Woods type thing that happened with China. And the Asian dollars all ripped higher and they broke their weekly charts and now almost look like we're in a whole new regime here. And this is something Mike Howell talked about. Now, check this out. Mike Howell just put out a note. This is slide 35. This is the global liquidity cycle, basically mimicking, in Bretton Woods, the dollar was too strong and it was cutting off liquidity to all these emerging markets. And this might have been a surreptitious kind of Bretton Woods Shanghai Accord. And we're following the same liquidity path. And I'll just read this from
when you mentioned that, Tyler, I know you sent this headline from Bloomberg last week where it was saying that, Yellen has come to an agreement with China around treasury stability, super vague, but is that what you're talking about?
Yeah, essentially. But the same thing. Yes, these things are all happening behind closed doors. And the move in the dollar was so drastic that it had to have been a political thing. It was so outside of the norm that you're essentially like, it was probably into the election. You want to goose things. You also need to goose things because you don't want China having like a giant credit crisis. And they're global vol controllers. They don't want tail risks in asset markets globally. Nobody wants that. So that's sort of like, globalized markets, you have globalized policy. And we're seeing that. And, now we're following the same liquidity profile as Bretton Woods. And then if you go to the next slide 36, so this is my don't get lost in the sauce chart. All global banks are now easing. So I just don't understand, unless there are credit problems in the system, this is a global liquidity cycle that is going up. It's not going down. And one of my favorite things, there's a guy Mike Guyed on Twitter. He's the biggest bear ever. I actually kind of like his stuff, but he's like, there's credit problems everywhere. I'm like, dude, you're not even looking at the credit market. I'll tell you where the problem is. And I'm going to tell you right now, here's the problem. During the ZERP world, this is where the problem was this time. It was in venture capital. It was in private equity. So venture-backed businesses, bankruptcies are up 60% year over year and accelerating. What our team finds concerning is that Series A and Series B companies, which in theory should be pushing towards profitability, are starting to shut down rates 3 to 4 times higher than 18 months ago. So this blue line is venture-backed shutdowns. It's in equity. The problem is in risky equity, which isn't affecting anything else. It's when you have a ZERP world, you have all these sociopaths that go raise capital and everyone's an entrepreneur. And now it turns out these businesses don't actually produce anything and they're shutting down. And that's why you're seeing unemployment. There was free money for all these nonsense companies to be created. One of my buddies, Carson Block from Muddy Waters, is like, we're living in a post-truth world. There's like non-profitable companies that have $6 billion market caps. Now, enough time has passed. That's coming home to roost. But now let's look at the credit markets. And I'll stop. I'm sorry, I'm talking a lot, but slide 28.
Let it rip, Tyler.
Yeah, this is the high yield market. Okay. This is JP Morgan's high yield spreads. This is yield to worst and spread to worst. So basically where the high yield market average yield is the blue line, spread to worst is where spreads are relative to treasuries. And that's the red line. We're going lower. The companies are financing at more advantageous rates here. So, and then go to leveraged loans, which is slide 29. This is leveraged loans, which is also, we're looking at these because they are the risky part of credit. It's the higher up in the capital structure, or lower in the capital structure, and equity sits on top of that. So these companies have basically refinanced and kicked out their maturities. Man, this is also one of the great parts about doing a podcast, but there's people like, I'm not necessarily a credit guy. I just look at like superficial macro credit. But one guy hits me on Twitter. He's got like 100 followers. His name is Hawk. And he hits me. He's like, hey, I'm one of the largest, I trade, CDX at the largest, one of the largest banks in credit. And he sends me this great note. And he goes, I think the major driver in the market is more on the left side, asset side of the balance sheet than the right side. I'll say when rates were elevated in the first half of 2024, you saw CDX on high yield sell off in large upticks in yields. You're not seeing the reverse as yields tick down. Rather, the high yield CDX has some outliers, basically like Carvana, which is a high yield issuer, is actually beating earnings. So he's saying the asset side of the balance sheet is getting better, in the face of all this, high yield is actually getting better. The companies are getting better. And then he goes on to say, there's been mention on the podcast how a larger percentage of the Russell index borrows at a floating rate. And as rates rally, that should be a tailwind. Yes, a lot of high yield has termed out. So basically the last year, the beginning of this year, there was a real problem with high yield. And they refinanced that debt out 3 or 4 years. So there's no real credit risk on the horizon, is what he's saying. And he said there was a lot of fear entering the year the maturity wall would be an issue. Here in the US, nothing is paid off, only termed out, and high yield proved no exception this year. And the maturity wall fear has been averted now. So to round out what I was saying was I'm not sure high yields rallying on the back of rates as much as it's rallying back on a viewable market impact. The same was it when rates were selling off. Basically, he's saying high yield and the consumer and unemployment are driving the right sides of the asset balance sheets. And now look at Carvana's stock, which is slide 31. This proves it perfectly. These companies have termed out their debt more. There's not a big, risk of bankruptcy. Carvana looks like it's going to rip here. It's the irony of all these people calling for a credit crisis. And it's, maybe I'm crazy, but I see problems. There's problems in commercial real estate. Yes. There's problems in VC and all this stuff. Until you see spreads widen and a real problem, I think you have to play. Like now the Fed's easing and you're going to get inflows into bonds. You're going to get inflows probably in equities. What I think you're probably going to get, and today we're seeing it is, look, IWM's up 3% now and the Qs are up 1%. This is rotational. You might not see, now we're going to concentrate on earnings, and large cap tech, I think, is pretty squeezed, in terms of how much they can grow. And now that we'll probably see that rotation into more traditional sectors of the economy.
Yeah.
All right.
Well said, Tyler. That was awesome.
Tyler,
here on it. Yeah. I want to pass it to you. Like, first off, what are your thoughts on that? Do you agree with it? And then how do you see that being reflected in crypto for the next 4 to 6 months?
I just wanted to ask Tyler also, you're going to say the curse words of fundamentals are back and, value investing is back in the
It's probably the quant guys just shifting. Yeah. We'll see. There's definitely
that's incredibly cursed. Never say value is outperforming growth because it means it's over.
It's literally, we're like 2 weeks away from everything just collapsing. And I do not want this podcast to be the canary in the coal mine for that. So
I like how you're busting my balls on the first time. It's great.
It's funny. Even on the Carvana chart, I was thinking about it. I was like, I didn't know it got so close to zero, to be honest. But something that I just automatically thought about is like, man, that really looks like Solana, to be completely honest.
Yeah, we're talking about same risks, right? Like
it's the same thing.
At the end of the day, I'm not saying crypto's the same as Carvana, but it's pretty close.
Right. There's a reason why these things trade in tandem almost, right?
Yeah, and that's why I watch high yield and leveraged loans and all those things, because I really care about Bitcoin and crypto in general. That's where innovation happens.
Right. It's the riskiest of the risk, like kind of like release valve of kind of liquidity that'll never funnel back into the system, right?
Totally. And it keeps as long as the credit system is working, that money funnels into, the frontiers. And I'll just show one last chart here, which I thought was fascinating. And it mimics the Asia dollar, but check out UFO. This is slide 34. This UFO is the space ETF, and this is partly why I'm wearing the American flag shirt, is like this broke out from a long-term weekly chart, and it kind of shows that we're starting a new cycle. If you're investing in space, and this is very liquid, it tracks a bunch of kind of space related companies, not total spaces. There's like Raytheon's in there, and but you also have Rocket Labs and Lunar. But what I'm saying is this: we maybe started a whole new liquidity cycle into different industries where we're going to the moon, baby. Like if this might be a whole new first turning, is sort of what I'm saying. Is we're moving from fourth turning to first turning. This is clearly in the fourth turning, but if stuff like this starts moving and you start investing in frontier markets, that's a great sign for America that we're going to get out of this stupid, global Cold War, kinetic war, and we're going to start, investing in frontier. So that's sort of where my head's at right now.
Yeah, I think that's super well said. And, we're going for fourth turning into first turning. And often during those transitions is political tensions increase. The dichotomy between political parties increases. The policy dichotomy increases. We're talking this week during a time where we've just come off the back of the DNC. And also there's been news coming out of starting to understand the economic policies of Kamala Harris and what she's thinking about. So I just want to pull up a couple high level takeaways of. All right, let's go into this. Try to see it from their side, even though it's very, there's an Atlantic piece that came out this week that said sometimes you just have to not trust the economists and just listen to yourself. And so it's difficult for me to fully look at this objectively, but man, some major economic policies are starting to come out from Harris's plan. So first off, $6,000 in newborn tax credit, $6,000 fully available to poorest families, a $25,000 down payment subsidy for first-time home buyers, $2,000 annual cap on out-of-pocket prescription drug cost, housing supply expansion credits. This one's a good one. Ban on price gouging for food, groceries, eliminate medical debt. And then another one that's not actually on here is there's this talk coming out again about taxing unrealized capital gains. That is something else. So let's start off the two I want to really nail in on is this, subsidy for first time home buyers and what that does to the housing market and the economy. And then also this, these ideas of unrealized capital gains. That to me feels like something that just gets said during election cycles, but is extremely unlikely to actually occur just because of, how significant the, deleterious effects of it could be on the economy and markets. Like if you're just like seeing your portfolio positions go up and down and then, you're having to be taxed on any sort of unrealized gain and then it reverses right after, like that just becomes way too risky. And then you're just going to have to want to, sell and de-risk as much as possible. So I don't really see that as being likely, but it shows the Overton window of what type of things they're thinking about, which is, equity type of gains and any sort of capital market gains are generally, looked down upon and need to be taxed. And on the other side of that is we need to basically provide fiscal stimmies to increase demand on already, squeezed assets like housing. So what do you guys think on all that?
There's so much to unpack. I think my main takeaway is that all of it is performative. All of it is like kind of like, Joe Biden tried to do the same thing, right? Remember, this is the same administration. There's no difference. There's no turning of any, this is not a Lyndon B. Johnson, kind of presidency era. At least not in my opinion. So I think all of this is a continuation of a lot of the cosmetic sort of economic changes, economic policies that the president wants to enact. But realistically, most of this stuff is like tired kind of policy that doesn't really work out. It doesn't, it's hard to enact. It's hard to really quantify like what are the rules behind each thing, right? Like price gouging at like supermarkets or whatever. Like, what do you consider price gouging, right? And then like as soon as that goes through, like automatically, gets litigated, right? Like immediately. This is like these things don't happen for a reason, right? I forget her name. She is the FTC chair, Khan. She tried to do this with Lena Khan, right? She tried to do this with like non-competes, right? Automatically, just like it's going to get overturned. Like there's just these things aren't that simple to kind of move forward. I think it's more of the it sounds attractive to people who are financially illiterate, which is like honestly most of the country. So it makes it quite simple to be like, this makes a lot of sense. Like we should totally do this. But in reality, none of this stuff will ever happen, right? Like it's very hard to get through any sort of like bureaucracy. And the number one question that people should ask is, why didn't this happen already, right? Why didn't this happen in the last 4 years? Well, even if they wanted it to happen, which I don't think they do, like they couldn't get it done, right? It's going to be the same thing. You'll have an even more polarized, Senate and House in the next, 2-4 years, right?
Yeah, I completely agree with that. Largely performative, and although I will say, like, I'll take the child tax credit thing personally. Here's what macro wise, like you have to pander to a large majority. The next generation, Gen Z and lower younger millennials, have been kind of alienated by the system. Like if you haven't been able to buy a house at low rates, you're kind of screwed, right? And so they have to figure out how to incentivize that. And I really do think RFK had one of the best policies by far in Bitcoin, making it a 1031 exchange. This was so overlooked. I don't know. I gotta go on and on about this, but if you make Bitcoin a 1031 exchange to roll it into another asset, you can delever the entire economy if you create a big Bitcoin bull market. Like you can delever the entire US national debt and, basically buy up all the commercial real estate that will be just left. You create a Bitcoin boom and then roll that into buying a building. Like think about that. But anyway, so I think to get away from the fact that I think the liberal policies are stale and they're boomer, they're driven by boomer incentives and they don't really hit home. Like you have 50 million people who own crypto and they can't touch it with a 10-foot pole. So I don't know. I'm shocked that they think it's a winning strategy. There's a couple of things they've copied, like the tips, no tax on tips. That's great. I love it. The child tax credit, love it. But they can get way more nuanced than price gouging at grocery stores, which have a 1%, gross margin or whatever margin. It's just nuts to me that they haven't, like, who's advising this at this point?
Like, look at these few charts on grocers. Like, just look at the profit margin throughout this whole, price gouging inflation thing.
Mm-hmm.
Profit margins have decreased. They've been decreasing since this whole thing started. When you look at like just overall profit margins, when you look at operating margins, like these are not the companies that are just, they're racking up prices because their costs are going up. So their profit margins are staying the same or decreasing if they can't fully pass on those prices to consumers. Like,
what they need to do is, this would be a better policy, but they can't do it because they want centralization, is antitrust. Just break apart these giant corporations that own there's 4 companies that own food. You just break them apart, but you can't do that because then you have to break the big tech companies apart. It's funny. They're kind of back themselves into a wall here where and it's the same thing with like the far left with Palestine and Israel. It's like you backed yourself into a wall and it's slowly death by 1,000 cuts is what I'm thinking. I'm kind of, not to be super political, but I just don't see any of these being winning strategies.
They're not.
Yeah, it's tough.
They're all cosmetic, right? They're all like at the margins. I think one last thing that like people should consider too in this like whole equation. It's like if you really consider like Donald Trump's like economic policy or like his stance, like he is not a classic Republican by like any means, right? In the same way that Kamala Harris is not a progressive by any means, right? She can sound in that tone, right? But realistically, this is very much the center needs to hold kind of thing, right?
What's up, everybody? Just want to take a second out of the show to talk about the next major Blockworks conference that's happening. Permissionless 3 is a leading crypto conference, and it's going to be happening in Salt Lake City this year from October 9th to 11th. There's going to be some major legendary speakers there from the likes of Balaji, Chris Dixon, and macro veterans like Dan Taffiaro will also be there. Not only that, but we're also going to be doing a live recording of the weekly Roundup on the Margin Guys Emporium edition, so you can come meet myself and Tyler and Quinn, and even Mike will be there. If you're interested, we have a discount code, Margin10. Use that and you'll get 10% off as well. So I hope to see you there and that we can catch up. All right, back to the show. Mm-hmm. Yeah, well said. Zaheer, something I want to ask you about is, your experience of, running a liquid crypto fund and being based mostly in the US. Like, there's a lot of talk about the crypto regulatory, Operation Choke Point 2.0 that's been going on under this administration. I just want to hear a bit about what's been your experience with that? How do you see it? And, as we're starting to see both parties sort of pander towards the especially that institutional crypto crowd that you're a part of, what are some of those unique implications and insights that you have?
I want to make one caveat, and I want to be super, super specific here. Both parties are not pandering to crypto. Donald Trump is pandering towards crypto. The Democratic Party is not pandering to crypto at all, in the slightest. And that is a very intentional decision that they want to make. And it's fine. They can choose to do so. If they don't believe in it, it's not a problem. But I just want to be very crystal clear. There's not two kind of fronts on this, right? Again, it's the same thing as the economic policy. It's all performative. It's all, we'll, give you guys a little thing for crypto, right? They could do it yesterday. They could do it 6 months ago. They could do it 2 years ago, right? Running a crypto business in the US is borderline a criminal enterprise, right? You're not going to go to jail for it, right? But you are essentially going to be treated like a blacklisted kind of industry, right? You can't get access to equal banking. You can't get access to, any sort of financial services. You can't borrow against your assets. People, LPs ask me, or other investors ask me, or I get on panels, right? They always ask me what's going to spark the Bitcoin run? What's going to spark? I tell them none of this stuff. None of this. I don't care about the macro. And I straight up, the only thing that matters is if people can get 20, 30% LTV against their IBIT, and they can go take that money and go do something else with it, right? We are a pure credit worthy market globally. Mm-hmm. How insane is that? No, there's no $2-3 trillion market in the world that does not have a massive credit operation going, right? If we had even 2021 level credit, or even half of that, asset prices in our space would be easily 2x, broadly, and individual assets would be materially higher, right? Think if you're a traditional investor, right, you're running a family office or you have a hedge fund, nobody is running 1-to-1 AUM versus GMV, right? That is just never going to happen. This is the only cursed space where we're operating at 100% spot, right? On everything. This is not a real thing for anyone who watches this, who works in crypto. Please understand that we are so far away from the norm of being a real asset class and being able to do any sort of financing at all. And we have to come up with these really weird, exotic products in order to get any money out of the system. It is not a real thing. There's no other countries that do it because no other countries really have credit markets like the US. So it has to happen here. And unfortunately, I hate to make a decision based off of one economic policy, but it seems like that's kind of the direction that we have to go towards. And one last thing I want to say on this front too. This is not if you're a bank, right? You want the clientele. You have stale products. How many more structured products are you going to sell in the last 20 years, right?
Yes.
It's not that interesting, right?
Amen.
In the same way that it's not that interesting. There's a reason why IBIT exists. There's a reason why ETHA exists. There's a reason why BlackRock is going after these markets super aggressively. There's nothing else to sell, right? What else are you going to go for? In this world where this is the only ball game, banks aren't dumb. JB Diamond, of course, wants to custody a bunch of BTC, right? They just can't. There's clearly a demand for it. They will make money out of it. They don't hate it, right? They just can't touch it. There's some sort of behind the scenes, I mean, probably from the Warren camp, just attack dog that like doesn't let crypto flourish. And for anyone who thinks that this is like, a net negative to society, there's really no American that will ever say, I don't want like progressive crypto policy, right? I don't want like innovative crypto policy. Nobody cares except for Elizabeth Warren, right? This is not
Yeah, I was going to
nobody's
say,
anti, right?
Besides Gensler and Warren. Yeah, it's true.
Like these are like, none of this is like, it's so perplexing that they're willing to die on this hill. And we'll look back on it as like the most absurd, draconian sort of treatment of any sort of industry. And they'll all admit to it at some point in time too.
It's not perplexing though, because it basically deconstructs all the power structures that they put in place. Like it makes, it's not.
But then you get humiliated on the other end, right?
Yeah.
Like if you think about it, like every single lobby in America got humiliated by Fairshake, right?
Mm-hmm. Yeah.
They just dominate. They're like, okay, you don't want to take it seriously. Now you kind of have to take it seriously, right? Like we'll put up more money than anyone else. Like, and they got humiliated, right? Okay, you don't want to give us like access to a spot ETF. We'll humiliate you in court. And that's what happened, right? Like there's clearly a political will where it can exist. It's the reason why it's like, this is how it's like done out of pure animus, because none of the decision making is calculated, right?
I think it's not
positive EV situation in my mind that this works out.
I think it's way more nefarious than that it's not just out of, trying to stultify a new industry. It's that they don't want people to look under the rock that they've been controlling for 40 years. That's the thing. If RFK becomes CIA director, that think about
God damn, I would not want him in there.
These are the power structures that like they've had in place. This is why the fourth turning and first turning, and in a lot of the decentralized world, basically like creates an earthquake for those institutions. So I don't think they're just doing it out of bad will. It's they want to remain in power, and it's all these boomer institutions are holding on. But the demographics, like you said, like no matter what, the demographics will allow this to come to fruition. It's just going to take a little bit longer.
I guess like the big question is whether any of that really changes depending on whatever party's in power. Like, when I think about the last Trump administration, like the guy, I forget his name, but the guy who's running the FBI right now, he was, put up by Trump and then continued on from the Dems. And, that side of things doesn't really change that much with political will. So, my question is, does much of that change regardless of the election outcome?
Yes, 100%.
You think?
Yeah, on 100% on the bureaucracy side. I think, okay, this is my kind of conspiratorial hat a bit.
Love those.
Donald Trump is a very big loyalist guy, right? Anyone who didn't support him, and especially in the last 4 years, is kind of out of any sort of consideration. This is why you don't see DeSantis trying to push for some sort of cabinet position. He knows he's not going to get anything, right? Like anyone who kind of went against the grain for Donald Trump, they're just kind of out of the spot. So I think whatever lesson was learned for in his first 4 years, I think those are going to be pretty ardent kind of going forward. I think also
Vance did call him a Nazi previously, and he's his VP. So
yeah, I think the Vance thing is probably the most perplexing one. Yeah, I would say that was mostly because his own kind of circles just pushed Vance super hard, and he was just okay, whatever. It doesn't.
Yeah, I think he wants to build middle America, and that's part of this. I wonder if the weak dollar is part of them anticipating a Trump presidency here.
Yeah, could be for sure.
Markets are always forward looking, right?
Yeah.
I mean, you'll see it. I think especially in vol, kind of closer to the election. Once vol just kind of sells off, markets determine the winner, right? Yeah.
I want to get your guys' thoughts on just going more so into the tactical crypto situation right now. This is a chart I put out yesterday, and it's just comparing last summer's price action of Bitcoin to this summer, and basically since last May, and it feels quite similar, and the vibes feel quite similar right now too. And and somebody will look at this and say, okay, well, the reason, we were chopping around aimlessly last summer with very little liquidity, and the only thing that brought us back was suddenly the pricing in of, oh my god, crypto ETFs are happening, and that sent us higher. So I see that as being valid, sure. And then looking at this summer, there's people that say, okay, well, why aren't we going higher when we have these ETFs? Like, there should just be this passive TWAP that just keeps coming in. But my answer to that is, it feels like, yes, we got that new marginal demand, but we've also unlocked every marginal supply bear case possible over the past 4 months. Like, now Gawk's German government, US government, like literally every possible bearish supply unlock has occurred. So that's going to be it's offsetting both, and now we're back in this summer doldrums. Zaheer, is that how you see it right now? What have you been seeing over the past summer in crypto?
Yeah, I think I want to add to that before we kind of continue. So there's this huge expectation that prices rallied basically in September because of ETF watch, right? Recall that when the Rubicon has not shifted, people don't anticipate that event to happen. People were discrediting Eric Balchunas and James Safard from Bloomberg the whole time up until November, right? November, December. So these are the Bloomberg ETF analysts, by the way, for anyone who's kind of paying attention. And they were pricing in higher odds in September, October. What's more interesting is not actually the ETF kind of murmurs. I mean, that obviously had a positive impact. But September 29th of last year, right, or close to that date, was when FTX started, kind of allowing the claims process to go through. So people could start liquidating their claims, and the claims market just ballooned. I wrote about this, quite a bit at the time, right? You saw claim prices reflexively kind of being the bid in the market, right? That crypto's winter was thawing out because of FTX being able to kind of, people wanted to buy claims, and debtors, were willing to kind of make that transaction. So that gave a lot of cash back to the market that was frozen. And obviously, it's pretty thin, especially on the alt side. So that's why Solana did particularly well. I think for this summer, like you said, you have, probably the largest spot sale, kind of period of time. Let's just call it the last 5 months. This is Kelly Greer from Galaxy, that she said something like $12 to $15 billion worth of spot sales kind of hit the tape in the summer, which sounds about right to me, right? It's a right, and it's a tremendous amount of value. And if you look at all of the ETFs, right, like for IBIT in particular, this thing is just eating through every single kind of sale, right? What happens once we're no longer in a summer kind of seasonality mixed with a lot of spot sales? There are no more overhangs that are material, right? We don't have the same kind of especially Gox in particular. This was a decade-long boogeyman that would come up every kind of 6 months, 6-9 months. That's done, right? U.S. Marshall coins done, right? These things are kind of working their way through pretty materially. And I think the market has gotten much better at anticipating this flow. And one last thing is markets are so spooked when there's a name to the face. You know what I mean? When you can identify a seller and say oh, Jump is selling down, $500 million worth of ETH. That's why we're going down. But to the untrained eye, that sounds like a lot. But realistically, $500 million worth of spot sales on ETH is pretty marginal. It's only because it's telegraphed that that number will multiply 6x, because now everyone else is front running that $500 million worth of ETH. So now you get multitudes larger kind of the spot impact on these assets. So
I gotta say, that's a great thing to me, because there's more volatility in the asset class, and it's because there's actual real buyers and sellers. And that's where, if you have more volatility in the asset class, there's actually more potential for return. And going back to your previous statement on credit and stuff, once the credit markets are actually there, the volatility gets lower and lower and lower, because then you can actually hedge out. There's better products, yada, yada, yada.
Right.
So I don't know. It's a function of the potential for price appreciation is a lot better. And I love that part of the whole ecosystem. But you deal with these crazy irrational swings.
Exactly this. And I think now we're kind of setting up for this. And also, one last thing, it's like we really just lined up really well with this like Kamala Trump trade, right? Like
Yeah.
BTC for a few weeks there became like the de facto Trump trade. And, when Kamala's odds started going up on like Poly Market, we started seeing that kind of invert a little bit. And the final point, it's like we had like a 4 Sigma event happen in Japan, like for Bitcoin to take it as well as it did, like it's perplexing, really. Um,
Yeah.
and this was the only liquid instrument open before futures even opened. We had what is it like the Wall Street weekend, like CFD or whatever. But like that's like that thing is like dust, right? So Bitcoin became this like liquid instrument for people to kind of speculate on while other markets are closed.
It's a really good point. It's slowly transferring into that store of value that gold was when we saw it. But it was a little bit more volatile. But the fact that it didn't go down 15%, it's pretty impressive, actually.
Yeah, it's transitioning in some ways. This is something I actually wrote about on the margin newsletter this week. It's just making the argument that plug, go sign up, it's free.
Plug
every day on the margin newsletter. Yeah. Plug it up. No, but something I wrote about it is making this argument that potentially the crypto bull market in its traditional sense has yet to begin when you look at real rates. And comparing, the way we measure real rates is basically the nominal, if you just take like the nominal, US 10-year yield subtracted by some sort of market rate of inflation. It's important to use a market rate, not CPI, because that's looking in the rearview mirror. So if you use something like, break evens, forwards, inflation expectations like that. So looking at the spread of that, the traditional correlation for gold is that as real yields go lower, gold goes higher. That broke in 2022 during the Ukraine invasion. And we've basically seen this premium in gold where it's just been going higher and higher. When you look at where real rates have gone over the last couple of years, we should not be breaking out the all-time highs with gold. That trend should only just starting to begin right now.
That's the point.
So that premium has been baked into gold. We've also had this other premium baked into Bitcoin in a way that I feel like is, maybe some ETF dynamics. But, when you look at traditional major bull markets, it's when real rates are either almost negative or outright negative, like in 2021. We're at the cycle high of real rates right now, and they're going to be coming lower as, like we talked about at the start of the show, the rate cutting cycle is starting in September. We know that now. As that occurs, real rates will start to come lower. As real rates start to come lower, gold will get that traditional correlation bid higher from real rates. That is not just based on the premium that we've seen, like maybe call it the geopolitical premium or something like that. So I feel like if you look at it through this real rates basis, what if we're just starting now? Like, what if we just had this weird early onset move from some of these like FTX dynamics or ETF idiosyncratic market dynamics that we've been talking about? And now we're getting the broad correlation bull market as real rates come lower. What do you guys think?
I like that read. I mean, I'm positioned that way.
Yeah, whether or not it's real, man. Like whatever pumps the bat. I'm kidding. No.
Well, it's clear that the consumer is definitely feeling a little bit of constriction here, and you can't have real rates this high. You need wages to go higher than they're servicing the debt. So those will have to come down. I think that's why we're seeing the early short covering, like that UFO ETF. I see a lot of charts very similar of companies that have basically based for 2 or 3 years. Nothing's happened. They've probably restructured their balance sheets, delevered a little bit, figured out their business models a little bit better. And I think that's sort of saying the same exact thing, where as real rates come down, maybe you get, the multiples go up on a lot of the beaten up stuff like ARKK type things.
Yeah, I was Tyler, on that point, I was gonna mention just now. I just looked at XBI, which is like the biotech index, right? Which is like the riskiest like junk in the world, right? Like
2-year base.
Yeah, literally, we're about to break out like 2 years of kind of downward markets, right? So this looks exactly like RK. And I think that is kind of like people don't remember, like RK was like the kind of golden child of like 21 that like BTC used to get comped against, and like RK got smoked like for all of
Exactly,
22 to
because
24.
it's just ultra risky, long duration tech, which is going to get battered during a regime of high real rates. So
Right. Exactly.
I feel like that shows like ARK has not rebounded like Bitcoin has. Will that come? I'm curious to hear. Do you see the altcoin space similar to that?
I was
Like,
going to
how do
say
you
that.
think
Yeah,
about it?
exactly.
Yeah.
Yeah, exactly this. So the way that we consider altcoins and like the way that like altcoins make sense to me is that, well, there's two things. Number one, like this is why the I think the Trump Kamala trade, I think, for the interim will end up being like Bitcoin DOM goes up in a Kamala presidency, and in a Trump presidency, actually, I don't think the trade is BTC. I think it's everything but BTC, if that makes sense. You get more lax regulation. That's the way that the market will interpret it. I think altcoins are more interesting. Sorry, Tyler, did you have something on that?
No, I was just going to say, I feel like, just to take the contra on that, if they're going to buy for a Bitcoin reserve, and try to delever the national debt, I think it's just I think Bitcoin goes up.
I'm pricing in odds of any sort of the strategic reserve at like negative, basically. But I would love for that to happen.
That's where I am. Geopolitically, lined up perfectly.
Right. But I think on altcoins, like what's more interesting is exactly this kind of narrative that like, we talked to investors like 6-9 months ago, right? And we would kind of like championing this talking point of crypto VCs dying, people aren't really getting any value out of this stuff. Alts will keep getting sold down into unlocks. And now like everyone I meet, even in like venture investors, they keep telling me like, oh, we're going to short the new stuff, long the majors. And I'm like, the contrarian in me is like, that's not going to work anymore, right? Like you're getting to the valuation floor of a lot of these things where like the unrealized gains for most of the founders are so high that they have every incentive to work hard on their project again. Whereas maybe like 9 months ago they didn't, right? That's like a scary thing on the short leg, right? Because they have so many tokens vesting across many years, right? Like, why would you want those to be worth zero? Might as well go work hard, and maybe they can be worth $1 or whatever it is, right? So that way you get some sort of value extraction for founders and teams that are still there. And now you're getting like, if you look at most alt BTC, alt ETH kind of charts or alt SOL charts, they're not really getting that same rate of change, right? So these are, against the majors, they're not really getting that, straight line down kind of price action. It's starting to like flatten out a little bit. And I don't think you're getting a whole lot of value out of being short those pairs like you did, 6-9 months ago. So, that market kind of will expand. And really the question you have to ask yourself, well, if, IBIT keeps getting a bid, and if ETHA keeps getting a bid, and if these two markets get a bid, will capital rotate? Will asset allocators rotate back into crypto native funds? Will they rotate into riskier tech like XBI or UFO or RK? If that's the case, then that's going to also happen in the alt market and crypto at some point too, right? So I don't think you can kind of like remove that part of this going forward. So this is, we were, I like to imagine we were pretty early to this like short alt BTC kind of like, thought process. But now I don't think the value is as attractive as it was like 9 months ago when you had like
the
20,
trade is
30
done
billion.
now.
Yeah. Like it's just, what are you really squeezing? Like you will get more value out of it, and on a long enough time horizon, yes, it probably will go down. But why kind of like get those paper cuts? In a world where rates are kind of coming off, and you have the potential of a catalyst in a new kind of presidency, right? Like that seems like a scary setup to me. I don't like it as much as I did a couple months ago when you had Starkware at like $30 billion FTV like day one. I was like, okay, like this seems kind of ridiculous, right? So
yeah, well said. Yeah, I mean, it'll be interesting to see how it turns out. Like to me, the unlock for those alts is if you get regulatory clarity where you can actually attach cash flows to these coins, like everything changes. In my opinion, it's less of just governance coins or actually like claims on cash flows. That could be really interesting. And unfortunately, it's tied to the political nature of this election, which is why we have to keep talking about this damn election. But it has relevant impact on markets.
To step back, this is kind of a framework my boss, his name is Mark Hart, came up with. But he's like, how do you value artwork? And he was basically trying to replace like the PE multiples and the fundamental analysis that analysts do on companies. And so he's like, why does art have value? And one of the interesting things, he comes up with like five attributes to value any asset, which is like access. So access, if there's a barrier to access, the potential for price appreciation is a lot higher. So that's, this political access thing creates opportunity. And it's actually like your opportunity for massive gain in investment. Awareness is one, which is like marketing dollars. Security or custody, which is like, can you custody the thing? Potential for price appreciation. Does it have like the potential for mass price appreciation? And then the last one was ability, use as collateral, meaning your ability to borrow against it. So artwork you can actually borrow against. But these are two things Zach said that, the collateral system and credit system in crypto is negligible, and the access is basically blocked by political means. So you have two attributes in those that should, if they get unlocked, should unleash a horde of investment sitting on the sidelines. Because like, especially use as collateral, like the tulip bubble, the reason like the tulips became such a crazy investment was your ability to borrow against them. And so that credit system, once it gets, unleashed, creates huge returns. And so that's like really important. And it lowers the volatility of assets as well, because like your ability to borrow against them creates a whole, system. So
yeah,
that's
I like that.
I'm watching.
I like that framework a lot.
It's different.
We're just getting
earnings multiples.
Yeah, totally. It's been a great chat, and I think just tying back to what we talked about in the beginning here, like to me the big thing on my mind right now is don't fight the Fed. Like Powell is as clear as he could be right now, and like just don't overthink that, and don't let summer illiquid price action skew you from where the fundamentals are headed. We talked a lot about just where the crypto market is headed and where it stands right now, just like the insane amount of supply that's been coming out to the market. It's been ridiculous. So, I mean, I just want to end this with just emphasizing that fact that like, it's clear where we're headed now for this. We got clarity today from Powell. There up until now it was a lot of just sort of inference and assumptions, but he made it as clear as can be. So that's where my head is at. Any last thoughts from you guys?
Have a great weekend, fellas. This was a fun one.
Yeah, America seems like it's healing again. I'm excited for
Don't jinx it.
God willing, brother.
Yeah. Zaheer, it's awesome to have you on. That was really fun. Where can people find more about you if they want to hear about you and your fund?
Yeah, at Split Capital on Twitter. That's where we post most content. We do, kind of the pod series, and Felix is gracious enough to have us on in the future. We're always happy to be back.
Awesome, guys. Well, yeah, have a good weekend. Don't fight the Fed. Peace out. There's over 500 protocols building on Polkadot, and one of them is called Polymech. Polymech is a decentralized, community-driven funding protocol on Polkadot, enabling regulatory compliant and transparent fundraising of Web3. Polymech ensures compliance with a novel KYC AML process, facilitating a trustless and automated funding process from fundraising to token distribution. By removing intermediaries, Polymech offers accessible, inclusive, and transparent funding opportunities for all participants. Powered by Polkadot, Polymech is redefining fundraising in the crypto space. Explore how to become a Polkadot VC at polymech.org.